Welcome to the Explainer. So, what if you could bet on a stock making a massive move without actually knowing which direction it's going to go? It sounds kind of crazy, right? Well, today we're diving into an option strategy called the Strangle, and we're going to use insights from Option Stranglers to see exactly how something like that is even possible. But before we jump in, you know the drill. We have to get the important stuff out of the way. Please remember, all of this is for educational purposes only. It is absolutely not investment advice, and you should always remember that any form of investing carries risk.
All right, let's get into it. To really wrap our heads around a strategy like the Strangle, we first have to nail down a super fundamental idea: the huge difference between trading a stock and trading an option. They are not the same thing.
And the source material uses a fantastic analogy for this. Think of it like this. Buying a stock is kind of like buying the actual racehorse. You own the horse, right? You're in it for the long haul, hoping it performs well over time and its value goes up.
Now, buying an option, that's totally different. That's like walking up to the betting window and placing a wager on a single specific race. You don't own the horse. You're just betting on its performance for a very short, defined period of time. It's an event.
And here's where it gets really interesting. This slide shows us the incredible power of options, and it all comes down to one word: leverage. You're using a little bit of money to control a much bigger outcome. So as the source points out, you could put $10,000 into shares and maybe make a 10% gain. Or you could take just $1,000 of those dollars, place a bet with an option, and potentially double your money on the exact same move. That's a huge difference.
So how do you actually place these bets? How does this work? Well, to get that, we need to look at the two absolute basic building blocks of the entire options work.
And honestly, it's pretty simple. There are really only two bets you can make. If you think the price of a stock is going to go up, you place a bet called a call option. And if you think the price is going to go down, you place a bet called a put option, up or down. That's it. And this right here, this illustrates the risk and reward so perfectly. Look, for both calls and puts, the most you can possibly lose is what you paid for the bet. Your loss is capped. But look at the other side. The potential profit, in theory, is unlimited. It just keeps going up.
Okay, so to make sense of any of this, you just have to get these three key terms down. First is the strike price. That's the specific price you're betting the stock will move past. Then there's the premium. That's just the fee or the cost of your ticket to place the bet. And finally, the expiration. That's the date your bet is officially over, win or lose.
Now that premium, the price you pay, it's actually made of two different parts. The first part is something called intrinsic value. You can just think of this as its real-world, in-the-bank value if you could cash it in right this second. It's the actual, tangible profit built into it.
The second part is what we call extrinsic value. And this is the fun part. This is the speculative value. It's the extra money people are willing to pay for the potential of a big move, and for the amount of time left for that move to actually happen. It's the value of hope and possibility.
And this table from the source material is awesome because it shows exactly how these two values, the real and the speculative, work together to create the total price. You can literally see how that premium changes as the stock price moves, and as that time value just melts away as you get closer and closer to expiration. Okay, now that we've got the fundamentals down, let's talk about the two big, invisible forces that are always pushing and pulling on an option's price. First up is something called time decay, and you have got to understand this. Every single day that ticks by, an option loses a tiny little piece of its extrinsic value. Why? Well, because there's one less day for a big move to happen. For the person who bought the option, time is always working against you. The second force, and this one is huge, is volatility. Now that's just a fancy word for uncertainty. The more unsure the market is about what a stock's going to do next, the higher the volatility gets. And that fear, that uncertainty, it directly pumps up the price of an option's premium.
So what creates all this uncertainty? Well, real-world events. Think about it. A company's big earnings report is coming up. A major news story breaks. The whole market just feels unstable and fearful. All of these things create massive uncertainty, which causes volatility and option prices to just skyrocket.
Okay, now we get to put all these pieces together. This is where it all clicks. Let's look at the specific strategy that the source material lays out for us.
And it all starts with this fascinating puzzle. What if you are completely convinced a stock is about to make a huge explosive move, but you have absolutely no clue if it's going to shoot up or crash down? I mean, how on earth do you trade something like that?
Well, the source material gives us a strategy for this exact situation. It's called the long strangle. The basic idea is you buy both a call and a put on the same stock and they have the same expiration date. You're betting on both directions at the same time.
And here is exactly how you'd set it up, according to the source. Step 1. You buy a call option with a strike price that's above where the stock is trading right now. Step 2. You buy a put option with a strike price that's below the current price. See what you're doing? You're basically setting up a wide net on both sides, just waiting to catch a big move.
So let's dig into that, because this strategy isn't really a bet on price direction at all. It's a direct bet on volatility itself.
The source material puts it perfectly. The whole idea is that you believe a really big price swing is coming, you're just not sure which way it's going to go. You don't have to be right about the destination, you just have to be right that it's going on a journey.
So think about what's happening here. You know going in that one of your bets has to be a loser, right? If the stock goes up, your put is worthless. If it goes down, your call is worthless. The entire strategy is a bet that the winning side will be so incredibly profitable that it pays for itself, pays for the losing ticket, and still leaves you with money in your pocket.
And that really leaves us with this final thought to chew on. In a world that seems more and more unpredictable, maybe the real opportunity isn't in trying to guess the final destination. Maybe it's in betting on the volatility of the journey itself.